This is Fintech Insider News. This week, Visa agrees a $2.4 billion deal to acquire BioCatch. InvestiFi raises $20 million for an embedded investing platform. And HSBC is to pull out of the Australian retail banking market. We're going to tackle all of these in today's news show.
Every successful business evolves. And to keep up, you need a bank relationship that evolves too. When you collaborate with KeyBank, you don't get one-size-fits-all solutions. Our expansive team of experts across industry verticals wouldn't be here if you did. Always ready with bespoke solutions for your biggest challenges and opportunities. We know all businesses are different, and that's why we approach business differently. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
Hello and welcome to episode 1088 of Fintech Insider News, brought to you by 11FS, the six-time consultancy of the year that works with financial providers big and small to build the next generation of financial services. I'm Benjamin Ensor, Director of Research and Strategy at 11FS. Now, to help me unpack the biggest and most interesting stories from fintech and financial services from the past week, I'm joined by three outstanding guests. First of all, we have a very warm welcome to the podcast for James Holmes, Chief Product Officer at Seccl. James, it's great to have you on the show. Can you introduce yourself and tell our listeners a little bit about Seccl?
Thanks, Benjamin. Yeah, it's great to be back. As you said, I'm James. I'm the Chief Product Officer at Seccl. Seccl is the embedded custody and investment infrastructure platform sitting behind a number of the UK's leading investment platforms and wealth managers. We're part of the Octopus Group, and we build infrastructure that enables other businesses to launch investment platforms, either within their own kind of customer journeys or using our UIs. Probably our most famous customer is Monzo, who we onboarded last year, but we also support GoHenry, Chip, and Quilter Invest.
Fabulous. Fantastic. And welcome to the show. I'm also delighted to welcome to the show Benjamin David, Head of Intelligence at the Payments Association. Welcome to the show. Could you also introduce yourself and the Payments Association to our listeners, to the extent it isn't obvious from the title, the Payments Association?
Absolutely, yes. So I'm Head of Intelligence at the Payments Association, and my role is really about understanding the forces shaping payments and financial services, whether that is fraud, regulation, emerging technology, or changing customer behavior. I work for the Payments Association, which is the UK's major payments trade association. Has about 250 members and works with a broad community of banks, payment firms, fintechs, and technology providers.
Amazing. Thank you. And I'm also delighted to welcome back to the podcast Dave Morris, who regular listeners will know, Chief Executive of FoundryOS. Dave, would you mind just reminding our audience who've not come across you before who you are and what FoundryOS is, please?
Yeah, great to be back, Benjamin. FoundryOS is an embedded banking and wealth platform that basically grew out of the 11FS world over several years. We're now part of 11FS Holdings Group, and actively sort of growing out that platform now across banking, wealth management, with our sort of first customers in different parts of the group and outwardly into the wider world beyond that. So exciting times, a lot of AI stuff going on with us at the moment.
Fantastic. Welcome back. Okay, well, let's dive straight into the news. So our first story is that Visa has agreed a $2.4 billion deal to acquire BioCatch. So Visa is going to acquire the Israeli behavioral biometrics firm BioCatch for $2.5 billion in cash. BioCatch's AI-powered platform analyzes behavioral, device, and network signals in real time to help banks distinguish legitimate customers from fraudsters. Protecting about 760 million users worldwide and serving more than 350 financial institutions. The acquisition follows Visa's broader investment in fraud prevention, with the company it's saying it has spent more than $13 billion on technology and infrastructure over the past 5 years. Separately, Bank of America has announced that it's acquiring UK cybersecurity specialist MD-Sec Consulting. Benjamin, it's logical to come first to you on this. Obviously, we've seen a lot of shifts in fraud over the past year or two, particularly perhaps driven by AI and the way that AI has undermined some of the sort of conventional ways that firms have developed. Visa's making a big bet here, $2.5 billion. That's a lot of money. Why do you think they're doing that? What's exciting about BioCatch? What's exciting about sort of behavioral signals? What's behind this, basically?
Yeah, good question. So I'll start with fraud, because fraud has moved from being seen primarily as an operational or compliance problem to being a genuine strategic issue, right? And its scale is obviously one reason, right? Fraud is becoming faster, cheaper, and easier to industrialize. AI allows criminals to create more convincing messages, right? Automate attacks and target far more people than they could have done previously. But there is also a commercial dimension here. So a bank or payment firms, as we know, right, can spend years building trust and lose it in a single badly handled fraud case. So fraud prevention now affects things like customer confidence, retention, reputation, and ultimately growth. And this is why a business such as Visa is prepared to invest at this level. And it's not simply, I think, buying another fraud tool, right? It's strengthening the trust infrastructure around the payment ecosystem. And what is particularly interesting for me is about, obviously, BioCatch, is that it's looking beyond whether a password or payment credential is technically correct. And it's looking at how someone actually behaves, how they type, how they hold a device, how they move through an application, and whether that behavior is consistent with the genuine customer. I think that matters because criminals can steal credentials, as we know, right? They can sometimes get through authentication. And behavioral signals are quite unique in that they can provide an additional layer of context that is much harder to reproduce consistently.
Yeah, that's a really nice point, because, of course, AI is remarkably impressive. Generative AI is remarkably impressive at faking all sorts of things. But, of course, it's probably a little bit harder to fake the behavior of a customer and certain signals, particularly if those are not known to the AI. I presume we all have various quirks that we're maybe not even aware of. But, okay. James, I was quite interested by the Bank of America announcement, although it's completely unrelated. Bank of America acquiring a consulting firm, because we don't often see, big financial firms actually sort of buying specialists and pulling them in-house. What did you think that was interesting? It struck me as a little bit unusual.
Yeah, I think it was hard to kind of get to the bottom of exactly what was behind it from the press release. I guess what we're seeing is kind of, as Benjamin said, firms are actively looking at any way in which they can strengthen their brand trust around these cases. Maybe Bank of America's kind of deeper thinking was around the fact that consultancies with deep expertise in this area can help build that. But I kind of tend to agree with you. It was quite hard to dig into the underlying motives from what was available online.
Yeah. Benjamin, back to you. I mean, do these deals maybe signal that actually there's some big firms that are starting to worry that they're potentially losing the arms race against cyber criminals, and that actually just, this is worth spending a lot of money on this because there's a really serious threat out there, or set of serious threats. Yeah.
Yeah. So are financial institutions bringing more of these capabilities in-house? Yes. Although I do not think this means the end, really, of specialist providers. What we are seeing in financial institutions becoming more deliberate about which capabilities they consider important fraud intelligence, right, cybersecurity, identity, and data orchestration increasingly fall into that category. Now, owning a capability can give an institution greater control over things like new data, product development, and how quickly it responds to new threats. But at the same time, what we know is that no single institution can develop every specialist tool internally. Of course they cannot. And the likely model is probably a mixture, right? So firms will want to own the strategy, the data architecture, and at the same time, no single institution can develop every specialist tool internally, right? So the likely model is a mixture. So firms will want to own the strategy, the data architecture, and the customer response, while continuing to work with specialist technology providers, where those providers often offer, deep expertise. So definitely bringing more of those capabilities in-house, but I don't think it means the end of specialist providers.
Thank you. Dave, there was another sort of AI-related fraud story this week. I'm not sure if you saw it. It was involving Metro Bank. And normally we're talking about AI being used to perpetrate fraud. In this case, the fraud seemed to be in order to spend money on AI. There was a Metro Bank customer who apparently lost £14,000 after fraudsters repeatedly bought credits for Anthropic's Claude chatbot, even after the customer told the bank the first transaction wasn't authorized. I don't have all the details of this, Dave, but I thought it was a pretty interesting story.
It was really interesting. I suppose it's you're buying your own lunch by using fraud to buy more tokens to then do more fraud. It was for me, the interesting part of this was what it shows is the sort of traditional approach that a lot of retail banks take around some of the sort of, particularly on the sort of card payment world of fraud, is about trying to just spot transactions as opposed to looking at more personalized behavior of customers and understanding actually what is normal for a customer versus a particular customer, rather than is normal as a pattern for all of their customers in blocks and types of customers. And I've actually trying to get more sophisticated around going to a very personalized fraud models, I think, is the route that everyone's going to have to take. Particularly as these models are only going to get more sophisticated. The fraudsters are going to use them in more sophisticated ways. I think there was some research that Anthropic pushed out a couple of weeks ago that they're now using every version of their model is built with 90% of the previous version of the model. So there's very little of their own code going into these things that isn't generated. So increasingly, they're going to actually understand less and less about the capabilities of these models as they go forward. So, it's going to be a race from one side to try and keep up with people on using these tools to prevent things, and the fraudsters using the tools to try and do things that we're trying to prevent. So it has to become more sophisticated. It has to become more personal. And I think in this Metro Bank story, it's clear that they were just spotting general patterns of things, because they managed to spot the first transaction and several of the others, but then others got through, which means that then they're really not sort of keeping a memory for that particular customer in that view of the world as to the context of the payments from that customer. Otherwise, they wouldn't have let it go through.
Benjamin, what are you finding? What are you hearing from your members in terms of the sort of use of AI to combat AI-related fraud? Are we in an era now where it's AI fighting AI? What are you hearing, and what are you talking about to your members?
So what I'm seeing is a really important change around the economics of fraud. So what we've seen in our research is AI is allowing criminals to produce content at scale, to personalize it and make it far more convincing. We know that a fraudster in 2026, right, can create really believable emails, voice messages, fake documents, or even synthetic identities much faster than before. And the industry is investing in AI as well. But criminals often have an agility advantage, right? They do not have procurement processes, legacy systems, governance committees, or regulatory obligations. They can test an attack, they can learn from it, and they can change direction extremely quickly. Now, our research has found that 76% of financial crime leaders believe that AI-enabled fraud is already moving faster than their current response capabilities. And that is a really significant warning. So firms need to adapt faster in three major areas: better data, faster decision making, and clear AI governance. And technology, of course, it really, really matters, but firms also need the operating model to deploy it safely and quickly. And it's also worth remembering that AI does not necessarily create completely new forms of fraud. And in many cases, what we're seeing, it makes existing fraud just a lot more effective. APP fraud, just authorized push payment fraud, remains the most disruptive threat for many of our members. In our research, 51% identified it as a major operational challenge. AI can make the impersonation more credible. They can also improve the language, right? It can simulate a trusted voice. It can help the criminal maintain a really convincing conversation over a longer period. And that makes the human side of fraud prevention increasingly important alongside the technology.
Well, I think you're convincing me that anything Visa can do to find and scale new, smarter technologies that help to stop some of that and scale that across Visa's billions of transactions is possibly billions of dollars well spent. Okay, well, we're out of time on that story, which is a shame because there's a lot more to unpack there, but thank you. Let's move on. Our next story is that InvestiFi has raised $20 million for an embedded investing platform. So InvestiFi has raised these funds through a funding round led by Vibe Credit Union, with participation from Bank Tech Ventures and several American credit unions and community banks. The company enables financial institutions to offer investing services directly within their existing digital banking apps, including fractional investing, exchange-traded funds, individual retirement accounts, IRAs, cryptocurrency, and stablecoins. A key feature is its investing from checking capability, enabling customers to invest directly from their bank account without transferring funds to a third-party platform. InvestiFi says it has grown from 4 financial institutions in 2024 to more than 60 credit unions and community banks, as banks increasingly look to retain customer assets that might otherwise move to external third-party investment platforms. James, it kind of makes sense to bring you in here because this is very much your area. It's quite an exciting deal. It's quite impressive growth from sort of 4 to 60 clients in a few years. It's kind of good news to see credit unions and community banks, sort of smaller players in the States, starting to offer better investing options to their customers, right? What did you think of this?
Yeah, 100%. I mean, congratulations to all the InvestiFi team. It's a great transaction. And I think it really does show the kind of momentum that embedded investing has right across the world. I think previously people saw you might have a relationship where you did your saving and your spending, and then a separate relationship where you did your investing. I think neobanks and traditional banks are kind of coming to the conclusion that, or making a bet that customers want all of these 3 things in a single place. And you can kind of see that in the UK, whether it's Revolut or Monzo, they have investing as a core part of their proposition, so that when people ideally get paid, they can kind of interact with one provider that can help them save money in cash for a rainy day or put some money towards a holiday, and at the same time invest for their future. And that's no longer just GIAs and ISAs, but also pensions as well, where people are where banks are helping them kind of get a much better handle on their financial life as a whole.
It's interesting because it actually goes all the way back, as I'm sure you know, to the Wall Street crash of 1929, which is when the Americans brought in these rules to separate banks and investment firms. And that separation lasted in the States for 60, 70 years. But it also sort of affected some other countries. It's an interesting point, isn't it, James, about, is there a risk that we see history repeat itself if everyone has all of their eggs in one basket? Or do you think that that particular issue might not recur. Do you think there is any risk there of people having all their money in the same basket, or is it actually really in lots of separate baskets? It's just managed through one interface.
Yeah, it really is separate. I think there's been lots of other kind of regulation that's caught up with the Glass-Steagall Act to help in both the UK and the US, like make sure that assets are protected. In the UK, we have the CAS regime. That means that providers like Seccl have to ensure that every pound that we're reporting to customers is actually in our bank account on a daily basis. There isn't this kind of commingling, and you certainly can't use investable assets to lend on, for an example. They are protected and ring-fenced. I think it's also why we're seeing like the rise of providers like Seccl and InvestiFi drive wealth in the States, Apex, where people are wanting to kind of outsource this capability to another provider who can help be on top of the regulation, but also make sure that the banks can specialize in what they do best, which is embedding and building a seamless customer journey, and they can leave, I guess, the infrastructure around investing to another party.
Thank you. Dave, what do you make of this? We've always sort of talked about super apps and things, and looked at some of the sort of Asian firms they've embedded everything into, or vast number of services into a single app. We're now starting to see more of that in Western markets, particularly in financial services, as we see sort of lending, insurance, investing, all getting embedded into banking apps. Does that just carry on until we have one app for everything, or is it just down to each individual to do what they wish?
I think for me, I think it is going to carry on, but different people have different mindsets to that, where they're quite happy that everything's in their bank's app, and other people go, well, I want to go and use a specialist for different parts of my portfolio of investments and other things. And I think that's a mindset thing for different people. But I think for the banks, the more they can embed different things, they keep them in the journey that they're trying to control. They can manage the sort of cross-sell and upsell of all of those things across services they have or they partner with. I think the thing that's increasingly different for me is if you sort of look back a few years, the banks would be trying to have all of this in-house. So it would be our own insurance company that's part of the group and other things, whereas now it's much more of an embedded play with partnership. I think if you went and looked at the terms and conditions at the bottom of some of your banking providers now, you'd see a whole list of, and this bit's with this company and this bit's with this company, and whereas it probably wouldn't have been if you went back in that. But so much is in there. How many people have got eSIMs in their banking apps and things like that now as well, and so you see it going beyond pure financial services plays in there across different things.
Thank you, Benjamin. You one of the things that I thought was interesting about this is that the community banks and the credit unions are investing directly in InvestiFi, right? So they're investing in it as well as sort of working with it. And you were just talking about how in payments, firms need to work more closely together, particularly perhaps smaller firms that have got fewer defenses or less sophisticated defenses against cyber attacks and fraud. Do you think this is, in a sense, part of the sort of same theme that the smaller firms, the smaller banks, the credit unions, building societies in the UK and so on, really need to sort of collaborate and pool resources if they're to match the sophistication of the bigger firms?
Yeah, and I think that's one of the most interesting trends in financial services. And historically, I think scale was a huge advantage because larger banks could invest far more heavily in technology. And what we're increasingly seeing is smaller institutions achieving scale collectively rather than individually. So whether it's shared technology platforms, fintech partnerships, or joint investment vehicles like this, collaboration allows them to access capabilities that would otherwise be difficult or uneconomic to develop alone. So it doesn't mean, of course, they lose their independence. Actually, in fact, it can help preserve it because they're able to offer customers their modern digital services without having to merge or dramatically increase costs.
Yeah, I like that. It's not about it enables them to preserve their independence. I really like that. James, I'd love your thoughts on the product mix here, because things like IRAs, retirement accounts, fractional investing, exchange traded funds, all make sense. They're all sort of, low cost ways of enabling people to sort of access the markets. But then there's cryptocurrencies and stablecoins in there as well, which I suppose feel a bit of away from a community bank or a credit union, serving a small community. What did you think of the product mix? Do you think those are relevant investments for community bank and credit union customers? Do you think it's just something they had, so they offered it? Or do you think that's something that customers are actually demanding?
Yeah, it's really interesting. It's a debate we have internally all the time about how do you respond to demand for consumers from these types of products? I suspect, if you're a bank, you've got the data on where people are spending their money. And if you can see that a large portion of your customer base is, sending money to Coinbase or Binance or whoever it might be to buy crypto, then I think you feel like you need to be demand-led and offer those customers those services within the product. I think it's a dangerous place to be for these banks to kind of be overruling and deciding whether a customer should or shouldn't be investing in that when you can clearly see the demand is there from the data that they have access to.
Without sharing all of Seccl's trade secrets, can you see some of the investors on the Seccl platform putting a lot of funds into sort of more exotic, more maybe higher risk investments?
Yeah, 100%. And I think, you only need to look at the kind of accounts of some of the more leading like challenger brands in the UK and the US. Like lots of them have made lots of their profit or revenue from things like CFDs, things that typically are bad for retail customers, right? It's quite hard to get away from the economics of the industry and what's good for the customer, often being kind of commercially opposed, if that makes sense.
Yeah, that's a really interesting point. Dave, what do you think on this? Because there is that sort of tension, isn't there, between offering customers what's best for them and offering customers what's best for the firm. How do firms get that right?
Yeah, but if you look at the sort of small regional bank and credit union landscape in the US, it's a very diverse population in different areas. If you're a credit union in part of Florida, you may have a fairly high immigrant population that are sending a lot of money abroad, and so having the ability to shift stable coins across there. Obviously, that landscape is very different as you go across different parts of the US. I think, as well as you embed some of these things, it becomes easier for people to do things. I know we've talked quite a few times on the podcast in the past about education of people about these things. If you give easier access to these things, you're giving people products they don't necessarily understand, and how do you educate people and make them understand without sort of, suddenly they've lost all of their savings because they've invested in some weird stock or CFD or something that they didn't understand how it worked.
Benjamin, is there a fraud angle here? Because one common fraud vector is fake investment schemes and people creating AI profiles of sort of famous personalities and using those famous personalities to sort of tout all sorts of fake investments and so on. But presumably, if customers have got easier access to investments on their own platforms, maybe does that make them slightly less likely to fall for things elsewhere? Is it actually a better thing if banks are helping customers make sensible investments on their own platforms? Does that make anyone less likely to fall for investment scams? Perhaps not. Perhaps I'm being too optimistic there.
We often talk about obviously making investing easier, right? But we should talk about making it safer. One of the fastest growing fraud threats, of course, is investment scams. We've seen this in a myriad of our reports, and AI is making fake investment opportunities look increasingly credible. And if banks are embedding investing into their apps, they also have an opportunity to embed protection, whether that's things like education, scam warnings, or behavior monitoring to spot when someone may be sending money to a fraudulent investment scheme.
Yeah, I think that's really, really important. Any final thoughts on this, James, either on that fraud angle or just more widely on InvestiFi?
Yeah, I think it's just that we're going to see more and more of this. I think, as both Dave and Ben have commented, it does feel like consolidation of your financial life into a single app is a real driving momentum in the industry. I think we're going to see more of it, like in the UK, in Europe, in America. That's super exciting for people like us. And I think it is exciting for the consumer as well. I think we're seeing more, like the evidence we get at Seccl is there's more and more people who have never previously invested who are choosing to invest because it's now embedded within an app that they love and trust. I think that's good for society as a whole.
Yeah, definitely. And as you said earlier, congratulations to the whole team at InvestiFi. Okay, well, on that note, we will take a quick pause here and we will be back very shortly.
Every successful business evolves. And to keep up, you need a bank relationship that evolves too. When you collaborate with KeyBank, you don't get one-size-fits-all solutions. Our expansive team of experts across industry verticals wouldn't be here if you did. Always ready with bespoke solutions for your biggest challenges and opportunities. We know all businesses are different, and that's why we approach business differently. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
Trading at Schwab is now powered by Ameritrade, bringing you an expanding library of education with even more ways to sharpen your trading skills. Access new online courses, insightful webcasts, articles, engaging videos, and more, all curated just for traders. Plus, guided learning paths with content designed to fit your unique interests. No sifting to find exactly what you need, so you can spend your time learning to trade brilliantly. Learn more at schwab.com/trading.
Before we get back to the news, we wanted to tell you about our latest Insight show. This week, we discussed one of the biggest financial decisions people ever make, which is buying a home. And I was privileged enough to be joined by a fantastic panel of Maria Harris from the Open Property Data Association, Daniel O'Connor from LendInvest, and Lucy Waymont from Wellness to explore why home buying still feels broken, how technology and artificial intelligence are reshaping the journey, and what it would take to build a truly customer-centric experience from first search through to long-term home ownership. So if you haven't listened to that yet, and you're up for a little bit more goodness, the episode is out now. Just scroll down in your feed. It's the one right below this episode. Okay, so back to the news. Our final big story this week is that HSBC is going to pull out of the Australian retail banking market. HSBC has announced it will leave Australia's market, closing its 19 branches over the next 18 months and selling its Australian mortgage and personal loan portfolio to Blackstone. The transaction is expected to complete in the first half of next year, 2027, subject to regulatory approval. The bank says the move forms part of its ongoing strategy to simplify the business. HSBC will continue to operate its private banking and institutional banking businesses in Australia, while retail products, including current accounts, savings accounts, credit cards, and mortgages, will be phased out. Australia's retail banking market remains one of the most concentrated in the world, with the country's 5 largest banks accounting for around 80% of the mortgage market. Several other international banks, including Citi, have also left Australia's market in recent years. Dave, I remember a time when HSBC was advertising in all of the airports as the world's local bank and sort of expanding into more and more countries. It now says it's part of a simplification strategy. What do you think's going on? Is this simplification? Or is this something else?
No, it's not simplification. It's about losing. If you just look at the volumes in there, they've only got 120,000 customers. That is not enough to run a bank in a country, in their sort of retail part of that. So they're just not making money. The probably the bigger problem on the volume of customers they've got is their mortgage book is very low, which means effectively they're probably losing money hand over fist to run that retail operation. So it's not simplification. It's about getting out of a market that they're probably making fairly heavy losses in, particularly if they're running 19 branches and things like that there. If you compare to Revolut, have got 1 million customers in Australia already, so you can see why they're going there with their banking license, and they're since 2022 they've been growing 100% each year, their number of customers. So whereas HSBC have stayed very static and been heading down in there. So for me, it's about getting out of the market that they're losing on. It's not a massive market. If you look at it in reality, there's only 27 million people in Australia, which if you think Greater Metropolitan London is 15 million. It's not a big market to play in, and it's very concentrated with all of the big players who are already there and are Australian centric. That you're not going to win, I don't think, in HSBC's world there, and so it's not simplification for me.
It's a big place, but not so many people. James, do you agree with Dave's analysis there that it's just HSBC just doesn't have the scale to compete?
Yeah, I think it's that. I think it's also to the point he alluded to about the difference in their business from Revolut, right? They've just got fundamentally different unit economics to someone like Revolut about how they can enter a market, right? Revolut can go in, they didn't have a full banking license, they can still acquire 1 million customers through FX. They don't need to have the lending book or the branches in place, and they can acquire customers at a kind of different price to HSBC. I think what we're finding is established large 3 or 4 banks in a country can hold their ground and still be kind of powerhouses in the financial services ecosystem. I think it's quite hard now for traditional banks using the same model they've used for the last 50 years to enter a new market at the cost point. You find it hard to imagine a scenario where that's going to pay off for them.
So what I find interesting in this is HSBC's selling off, closing down the retail banking parts of the business, but keeping the institutional and private banking business. But part of the reason, presumably, they're losing in retail banking is because they're not attracting customers and so on. And okay, fair enough. To the point you're making, James, and Dave, Revolut's coming in and it's attracting and winning younger customers, and there's lots of Australian firms doing the same. Benjamin, at what point do the private banking customers, who are presumably older but also wealthier, at what point do they say, well, hang on a minute, we also want modern digital services? And to be fair, I don't know what HSBC offers in Australia, but are we going to see the same movie play out in 5 years' time with private banking that we're seeing in retail banking? What do you think?
Yeah, I think first thing, it suggests that HSBC believes its international network remains a meaningful advantage for wealthier clients and large institutions. I mean, those customers may need cross-border banking, international markets, trade finance, investment, expertise, or access to a global balance sheet. Now, retail customers, by contrast, as we know, are often served very effectively by domestic banks with larger local distribution and stronger market share. So in my view, the decision, I think, reflects a difference in where HSBC's international capabilities maybe provide genuine difference.
Do we think that part of the challenge here is just indeed the sort of the scale of the market, right? Because if you're because there was a time when I think there were about 4 or 5 digital banks all launched in Australia, and yet some of them really struggled. Is there a point where an economy is just not big enough to support a large number of banks? So if you're a New Zealander, if you're an Australian, if you live in smaller countries, if you live in Singapore or whatever, you're always going to have a little bit less choice of provider.
Yeah, I mean, there's probably a point at which the economics become extremely difficult. The retail banking carries very high fixed costs. Technology, compliance, fraud prevention, and servicing infrastructure, right, are expensive, regardless of whether the bank has 1 million customers or 10 million. And scale allows those costs to be spread across a much larger base. And a smaller provider, of course, can still succeed, but it usually needs a really distinctive proposition, like a lower cost model or a very specific customer segment. And simply offering a small version of the same service as the market leaders is really unlikely to be enough.
James, there's definitely an irony here, isn't there, in Revolut acquiring a banking license in Australia specifically at the same time, or more or less the same time, that HSBC decides to exit retail banking. That feels like a bit of a changing of the guard moment, doesn't it?
Yeah, it almost feels like a handing of the baton over from the kind of old traditional bank into the new challenger. And yeah, totally agree with everything that's been said before. I think there's just fundamental challenges in the economics that these traditional banks, especially in a market like Australia, which isn't quite necessarily as big as some of the others, about how many banks they can feasibly support, especially in that traditional model. I think Dave said at the start of the segment that 120,000 customers just isn't anywhere near enough to run a bank like this. And I think we're kind of seeing the benefits that a firm that's nimble and agile as Revolut get in terms of how they can enter a market and dominate it without that traditional infrastructure.
Dave, what do you think on the sort of private banking point? Do you agree with sort of Benjamin that maybe HSBC's got some more assets there, some more things that it can sort of protect that customer base and serve that customer base more effectively than it's been able to in retail, where it's tough to differentiate, you need scale, the margins are lower?
Yeah, definitely. Private banking is a very international world. We do a lot of work with Monaco private banks and things, and that it's such a spread network out across so many different areas and different international geos and things, and ties into the business world because you've got a lot of entrepreneurs in that space. And so that's a place that HSBC know they can play well in, and that the unit economics of that are much easier to do. You can make a lot of money on a lot of those services that you're building in a wider network of not just a sort of small set of retail products that have to only succeed by volume, and so I can see why they're sticking with what they're doing from a investments and private banking perspective, because that's their bread and butter. That's what they do well, and they're not going to move away from that at all. So yeah, I see why that strategy works well for them.
It's really interesting because if you think sort of 10, 15 years back, the sort of global international banks, sorry, that's an oxymoron, same thing. The global banks, there were firms like Citi, HSBC, BBVA, Santander, etc., that were in dozens of countries, Standard Chartered. Even Barclays was in, a whole bunch of markets across Africa. And gradually we've seen them retreat. And yet now we have N26, we have Nubank, we have Revolut, all pushing out in retail banking. Does that story keep playing out? Do we see this happening in other parts of banking as well? Does this move into institutional, into private, etc.? How far does this play out? Benjamin, what do you think? Oh, sorry.
If you look at all of those, their unit cost per customer is so much lower than the traditional banks, so they can do that. What Revolut's cost per customer compared to a Lloyds banking group in the UK is just crazy, the difference. And so they can work at that, and they can start in markets that are loss leaders, and they grow in and have time to grow into. I think the traditional banks want to see things succeed very quickly, and they've not got the depth of things like the sort of private investment of Revolut to be able to actually go and do those things in a different way to when you've got to report to the stock market every quarter.
I think the other thing that's on that is, though, that those banks you mentioned, HSBC, Barclays, like their financial performance over the last 5 years has not been bad. It doesn't. The kind of stories of they've been retreating from lots of markets don't necessarily align with their financial performance. And I think maybe what will be interesting is as these banks, N26, Revolut, Nubank, as they mature and they kind of diversify their revenue streams, perhaps they'll take a different take on what's important, right? At the moment, their revenue streams are typically based on either cash interest margin or kind of subscription fees, and therefore expansion and customer numbers is the biggest metric that they can kind of focus on. I think as that revenue per customer, revenue per deposit starts to go up, it'll be interesting to see how their strategy evolves. I don't think it will follow the banks, because I think what Dave's point is around the cost of operating in these markets is just fundamentally different from them. But it might be interesting to see how that impacts their strategy and where they choose to spend their time.
And I do think that more international banks will narrow their geographic footprint, particularly where they lack scale or a clear point of difference. The global banks, of course, will continue to be international, right? But they will be more selective about the products they offer and the markets in which they try to serve mass market consumers. We may see fewer institutions attempting to be universal banks everywhere, and more, I think, focusing on areas where their network, technology, expertise, or customer base gives them a defensible advantage, ultimately.
Indeed. Thank you. And James, yeah, you also made a great point. Of course, the banks have got good returns is partly because they are cutting back these less profitable or loss-making parts of the business. So absolutely. Okay, well, we will take a quick pause here and we will be back very shortly.
Every successful business evolves. And to keep up, you need a bank relationship that evolves too. When you collaborate with KeyBank, you don't get one-size-fits-all solutions. Our expansive team of experts across industry verticals wouldn't be here if you did. Always ready with bespoke solutions for your biggest challenges and opportunities. We know all businesses are different, and that's why we approach business differently. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
Okay, now for a quick look at one story we don't have time to cover in full, which is that Western Union has launched Stablecard. Western Union has brought out this new digital wallet and a Visa-backed secured credit card designed to let customers hold, move, and spend value using its US dollar stablecoin, USDPT. Developed in partnership with stablecoin payments infrastructure provider Rain, the product is launching across 37 countries. Customers can store funds in USDPT through a digital wallet, spend them anywhere Visa is accepted, and redeem the stablecoin on a one-to-one basis for US dollars, with the token fully backed by reserves. The launch marks another step in Western Union's expansion into digital assets, combining stablecoins with its global money movement network and Visa's acceptance infrastructure to offer customers an additional way to make cross-border payments and manage US dollar value. I said, this is a really interesting story because, we're used to thinking about, Western Union as a money transmission network. We're used to thinking about stablecoins as a way of people moving money from one country to another. But the spin here is that a card that enables you to spend value means that suddenly you can spend your US dollars in whichever economy you happen to be in. So not only is this enabling you to move money between countries, but it's enabling people to hold dollars and spend dollars in their own country. And that actually raises some really interesting questions about sovereignty. And there are governments that are going to be looking at this and thinking, is this good for us to have our citizens holding more and more of their assets in stable coins? Because ultimately that starts to create some real questions and challenges for governments in particularly smaller countries all around the world. So that's more than we can unpack in this show, so we're not going to, but it's a super interesting topic and one I think we'll come back to. So let's move on to our final story of the show, which is that Billionaire Revolut founder Nick Storonsky has been sued over a $300 million super yacht sale. So Revolut's CEO, Nick Storonsky, is facing a high court claim from a luxury yacht broker, Seccl Wright & Partners, over the purchase of a yacht that's reported to be worth 350 million euros or 300 million pounds. The brokerage alleges that it introduced Storonsky to the yacht before he completed the purchase directly with the seller and is seeking 17.5 million euros in commission. Storonsky's family office has described the claim as being without merit and says it will defend the case. The yacht itself is reported to feature a glass-bottomed infinity pool, beach club, and cryotherapy chamber, making it one of the most expensive private yachts in the world. And apologies to those of you listening if you think I mispronounced cryotherapy. I've not actually come across the term before and I've never had to say it before. I think it's that thing where you try and preserve your life forever, but I'm not sure. Anyway, this is a bit of an interesting one. Where do we start on this? Unnecessary luxury purchases or the danger of having your business model tied to the completion of a contract and you can't ensure that you're part of that. Who wants to start on this? What are your thoughts?
Seems like you could have worse problems in the world, couldn't you, for being sued for purchasing a $350 million yacht? I don't know. Don't think my heart quite pours out for him just yet.
Yeah, it's definitely not even a first world problem. I mean, it's a sort of a billionaire problem, isn't it? Being sued, but the sheer, the 350 million euro yacht, that's extraordinarily expensive, isn't it? Okay, how about this? If you could spend a week on any billionaire's yacht, whose yacht would you choose, and where would you want it to head to? Dave, if that's not an impossible question, if you could spend a week on the yacht of a billionaire, whose yacht would you choose, presuming they're on it, and where would you want to head to?
Oh, it's an interesting question, isn't it? It probably have to be Elon Musk to go and find out where his sort of that island of James Bond evil villainness is. Yeah, you must have one.
Fair enough. What about you, Benjamin? Which billionaire would you want to spend a week in the company of, and where would you want to go?
Honestly, I would choose whichever billionaire has the best chef and the least interest in being on the yacht at the same time. So then I would maybe head somewhere around maybe the west coast of Scotland, like some really beautiful scenery, excellent food, and I think just maybe enough unpredictable weather to make the yacht feel genuinely useful. But good food is it's a must.
And how about you, James?
I don't know if it's cheating, because I think I'd pick Steve Jobs. I'd love to have been able to have an opportunity to ask him. He seems like Elon has got a bunch of crazy ideas, and I think it would have been super interesting to spend the week with him.
Well, I mean, none of these things are going to happen, so I think that still counts. I doubt Warren Buffett has a yacht, because I think he's just far too practical a man. But I've always admired Warren Buffett and always thought he has so many pearls of wisdom that I think he'd be quite an interesting gentleman to spend a week with. And I'd love to go to the Leeward Islands in the Caribbean, because I've never been there. I'd love to see them. Okay, well, that wraps us up for today. Thank you so much to the three of you. Where can people find out a little bit more about you? Benjamin, where can people find out more about you and the Payments Association?
Yeah, you can find out more about our work at the Payment Association via our website, including our research, our policy work, and the industry events, including Financial Crime 360 and, of course, Pay 360. And I would maybe encourage listeners interested in today's full discussion to look at our UK Financial Crime Pulse 2026 report, which explores things I've discussed today: AI-enabled fraud, APP fraud, insider risk, regulation, and the need for greater collaboration across the industry.
I will definitely look that up. Dave, where can people find out more about you and FoundryOS?
Yeah, find out about me. I'm on LinkedIn, and then all of our content is on foundry-os.com, and our blogs are there as well, which is an interesting read from the team on the things that we're working on at the moment, and probably a slightly different, less corporate way of the sort of day-to-day stuff that we're doing.
Fantastic. And James, where can people find out more about you and more about Seccl?
I'm also on LinkedIn, so feel free to contact me there. And our website is seccl.tech. That's seccl.tech. And yeah, lots of information on the website.
Thank you. And as for me, Benjamin Ensor, you can find me on LinkedIn, and you can find out all about what the team are up to at 11fs.com. So that wraps up today's episode. Thank you so much for listening. Please do follow us on your favorite podcast platform of choice, and please do recommend us to a colleague or a friend. If you want to join the conversation, seek us out on social media. Just search for 11FS or Fintech Insider. Thank you all again. Thank you so much to my three panelists, and goodbye.
Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out That's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3 months, $90 for 6 months, or $180 for 12-month plan required. $15 per month equivalent. Taxes and fees extra. Initial plan term only. Greater than 50 gigabytes may slow when network is busy. See terms.
I'm not giving up. I am selling the building.
The final season of FX's The Bear.
The restaurant is flooded.
Everything's either going to be okay.
No, stop!
Or not.
We are outgunned and we are outmanned, but we have each other.
FX's The Bear, the final season. All episodes now streaming on Disney+.
Your team just added its 67th AI tool, and also your 67th security blind spot. The good news? The Vanta agent works like a GRC engineer in the background, finding every app your team uses, scoring the risk, and drafting fixes for you. Vanta is the platform used by over 16,000 fast-moving companies like Ramp, Cursor, and Harvey, who are shaping the future with AI and staying ahead of AI risk. Get started at Vanta.com.